So good afternoon and many thanks for all those who have connected to this call. Today, as usual, our CEO Max will take you through the main updates in our business. And before that, our CFO Lorenzo will run you through a detailed analysis of our financial performance. But let me start with this snapshot of our Q3 numbers. There are three messages we want to convey today. First, our top line, which recorded another acceleration in growth compared to the same period last year. Second, our continuous margin KPI progression, with both gross margin and EBITDA reaching their best levels in 2 years. And third, our guidance for the end of the year, which we are in a position to reconfirm both on top line and gross profit. To complete this picture, we also wanted to reiterate some of the key milestones we achieved in the past 3 months. On the business side, this includes the launch of our first joint product with Raspberry Pi, the Pi Vision, based on their latest CM5 chip. We also launched our ClearVent telemetry platform, consolidating our historical leadership in that vertical. And more broadly, our application hub continues to fill with a growing number of algorithms on track to reach our target of over 150 dedicated solutions by early next year. Let me now hand over to our CFO Lorenzo for a more in-depth look in our numbers.
Thank you, Clarence, and good afternoon to all. Let's take a look to the key financial highlights on the 9 months 2025 KPIs. We are up 5% year-on-year on sales, with a plus 9% in Q3 25 respect to Q3 24, increasing from the plus 6.5% of the second quarter 25 respect to the second quarter 24. The growth is coming from all main markets, under recovery on 2024 overstocking context, with the exception of Germany, which signs a minus 30% year-on-year. Software business is growing for the recurring revenue part at plus 11%, driven by the progressive increase of the connected devices to the platform. For what concerns gross profit margin, really good performance is recorded in Q3 25, with a 55% profitability. This thanks to multiple factors: the contribution of software sales, a positive sales mix in edge computing on profitability terms, and good purchasing results on electronic components. But most important for us is the EBITDA indicator. We are plus 50%, 50 year-on-year, with a 22% EBITDA margin recorded in Q3 25. Key driver of this result is the operating leverage over decreasing OPEX, thanks to lower manufacturing cost recorded quarter by quarter during this year. Adjusted net income increased by about 10 million year-on-year, primarily as a result of the EBITDA performance. I want to point out the reduction of interest expenses in the period by 600,000, thanks to the progressive deleverage and to the official rate reduction. Passing to commenting the sales trend by area, it's important to point out that year-on-year all key geographic areas grow at more than 20%. The only exception is Germany, featured by a difficult economics and industrial context, which registered a minus 30%. Please consider that even EMEA, excluding Germany, recorded a growth higher than 20%. Having a look to the end market, our key verticals experience a double-digit growth, industrial and medical in particular, The only exception is vending, impacting by the destocking matter over a German customer. Let's pass to the adjusted EBITDA performance in the 9 months of 2025. We recorded at 21% in profitability terms, with a really strong 22.2 in Q3 25. Other than sales and gross margin, the main driver of these results is the 4.6 million OpEx reduction, these excluding non-recurring items. The higher contributor to this achievement is the production efficiency. Consider that manufacturing costs decreased by 2 million compared to the same period of 2024. For what concerns non-recurring adjustments, in these 9 months are almost all represented by the stock option actuarial value. For what concerns instead net financial position, in the third quarter, the group had a cash generation of 2 million, adjusting the KPI by the growth investment of the 2 new plants in Arezzo and China for a total consideration of 3 million paid in Q3 25. On financial side, I want to point out the good leverage ratio just above 1 times EBITDA calculated on the last 12 months. Thank you very much for your attention. I pass the talk to Max to continue with our presentation.
Thanks, Lorenzo, and good afternoon to everyone. Now let me spend some time discussing our business and its prospect going forward. As you know, we are standing at the crossroads of a technology revolution. Artificial intelligence is transforming the industrial sector, unlocking new ways to operate, optimize, and scale the business. Whatever is smart automation, immersive human-machine interaction, and real-time data monetization. All these are enabling faster, smarter decision and driving a dramatic transformation into the industrial field. But despite this potential, it's a matter of fact that the adoption of the AI in the B2B nowadays remain slow. Why? Because OEM face a fragmented tech stack, a poor interoperability, and a complex stakeholder coordination. Legacy system only add to the challenge. That's why the winners in this space won't just offer powerful technology, they will radically simplify its adoption. And this is where I think SECO will mark a significant difference. And this is our mission to really become the better partner to simplify the usage of the AI at the edge. Through the years, my vision for SECO has been to offer a fully integrated end-to-end solution. Now we are really there, everything is ready, and I think thanks to it, we can really simplify and accelerate the adoption of Edge AI for the OEM. In fact, with our modular vision HMI system and our own stack software framework CLIA, together with all the recent launch of our dedicated AI algorithm app store, they will really offer an end-to-end solution ready to be implemented into the OEM and solution and product. So this is where our strengthness in R&D will mark a significant differentiation factor between ourselves and the rest of the competition. And thanks to our decade of expertise, we bring now verticals know-how into connected solution, enabling new business model to accelerate further the growth of the recurrent part of our software business. So if we go to the next slide, here we prepared some example to make it simpler in terms of comprehension for everyone. This is divided, and we will see it in three different kind of vertical, but you can imagine something similar, of course, for any vertical. And this is where our capability to digitalize the product of the client, both on the hardware and on the software side, really make a huge difference also in terms of user experience. So the picture is extremely clear. I don't want to say too much else. Just everything that you can see here is digital payment, tailored refiling, dynamic pricing, predictive maintenance, all this kind of value-added service unlocked thanks to our software suite, Clea. If we go to the next slide, we can see, in fact, how the vertical for the vending space, Clea Vend is working. And this is an example how our platform, which is hardware agnostic, works and really provide smart data and AI analytics ready to be used and leveraged by our customers. Moving forward, I think this is another good example. Take it as a reference example for any kind of industrial factories. Here you can see how for Garbulzera, which is an Italian producer, we really simplify their production line, combining modular vision with Clea, being able to directly showing on the production line a lot of essential KPI, quality, production, so on and so forth, to really help the customer to increase efficiencies as well as production numbers. Another strong example on the energy is, of course, what we are doing with Hitachi Energy, where basically we combine again our strong expertise on the hardware part, producing for them, designing and producing for them an integrated grid computer to manage the distribution of the energies across the second station, as well as integrating all the data within Clea. This is providing an unparalleled solution to really help the customer to manage a lot of complexity and a lot of interaction between himself and all their business partner. So I think looking this as such of example and thinking about what we are doing into the application hub, you can really understand which is the potential, which is completely unexpressed right now of our software offering. As we go, we are continue adding new application made by SECO and also by partners to our application hub, which will be launched later in the beginning of January 26, and it will unlock another piece of complexity, providing the capability to the customer to really implement AI on a device very quickly and in a super simple and user-friendly way. All in all this such of solution are always hardware agnostic, and this is important to be able to cover also from a software perspective customers that are not using SECO hardware eventually. So finally, let me introduce our launch on the Raspberry Pi Modular Vision. This is an amazing new product, low cost, to cover the industrial demand. We will start to sell it during the first quarter of the next year. And of course, we are expecting to have an acceleration of our organic growth thanks to this product, which is, by the way, one of a family of new product that we are launching right now, and we will expect to receive orders and therefore revenue in the forthcoming quarter. This is important also to mention. In this product, it's available CLIA, so the framework is already pre-installed and potentially available with a few clicks for any customer. So let me go into the investments that we are doing into the production side. In this picture, you can see the new facility, which is located nearby Arezzo, our headquarters, at 3.5 thousand square meter, very new building that will be up and running by the beginning of the second quarter next year, and will increase our production capacity by 50%, and will provide also additional saving in terms of cost, reaching efficiencies at the maximum level. I think we can go now to the KPI of the company. We have a solid KPI. I think this kind of KPI are really helpful to understand also which could be eventually the future of our growth. Looking the backlog and the order intake, you can appreciate that it is up by 10% year on year already, and our book-to-bill continue to be healthy, and all these key indicators are really confirming the good trend and of growth that we can keep in the near future. Just to conclude my speech and leave space for a Q&A section, I want to reiterate and fully confirm our guidance, which is set at 200 million plus in a constant currencies effect. I think we covered all the main topics of this publication, and I'm now happy to take some questions, if any. Thank you very much to all.
Thank you to the speakers today. We now have an opportunity for questions. As a reminder, if you would like to ask a question, please use the raise hand function on your screen, or for those dialing in, it's *9 on your keypad. Once your name is announced, please unmute your line, state your company name before asking your question. Thank you. First question today comes from Mr. Marco Vitale. Please, the floor to you.
Good afternoon. Thank you for taking my question. The first one is on the outlook. We appreciate that you have confirmed your full year guidance. I was wondering if you could provide us some additional insights on the order intake trend. Also, what are the business pipeline as we are heading to 2026? The second question concerns the profitability. Once again, you have delivered very strong operating leverage and also very healthy gross profit margin. Going forward, do you still expect, say, additional margin expansion coming from operating leverage? Also, take into account that you will ramp up the new capacity, the new plant in Arezzo also in the first part of the year. So I was wondering if this could have some, say, headwind in terms of a profitability expansion going forward. Thank you.
Thank you. So about the revenue, we are expecting to the last quarter of this year very strong, with our revenue well above 50 million. It will drive us into a landing figures which is fully confirmed and which is reflect and beat potentially the guidance. I think all the orders are already there. It's a matter of execution. We are executing well right now, so I have no doubt that this part will be covered by the end of the year. In terms of profitability, the good trend that we are having, I would expect it to continue because in some way structural in terms of business model. As we go, we will continue to increase piece by piece, proportionally, the revenue side that is coming from the software, and it will provide us additional headroom to improve our profitability. As well as the new building, I would assume to see it fully working by sometimes in May next year. It will drive in the second half of the year, of course, efficiencies and so reduction in terms of our production cost.
Thank you.
Thank you, Mr. Vitale, for your questions. Next question today comes from Mr. Filippo Mazzoleni. Please, the floor to you. Mr. Mazzoleni, kindly unmute your line.
Hi, everyone. I have a couple of questions. The first one regarding CapEx. Out of the 33 million one-off plan, could you please share the split between tangible and intangible and indicate when the remaining 7 million is expected to be spent? I mean, the second quarter 2025 or the first quarter 2026 or later? And secondly, on gross profit, could you give a bit more color on the business mix driving the margin improvement and on the savings achieved on purchasing? Thank you.
Right. I will cover the one on the gross profit, and I will let Lorenzo to cover the one on the CapEx. On the gross profit side is split between a mix of three positive factors. One, as I said, is the software. The other one is because we are able now to buy components at a better price without reducing the price to the customer, and this is giving us an additional headwind. And the last but not least is, of course, due to a mix in the sales where medical and defense are more present against, for example, industrial or vending, and those two vertical, of course, provide us definitely a better margin than the others. And so, as a mix of the three is due to this such of results in the gross profit. Bottom line, I think a good portion of it is long-term sustainable.
Yes, so thank you, Max. So having a look to the CapEx for these first 9 months, 2025, and the split between intangible and tangible, we recorded about 12 million in intangible CapEx, on which, as you know, the biggest part is represented by the R&D capitalized over standard product. The residual part is tangible CapEx, and on this residual part, 3 million are represented by development extraordinary CapEx relating to this new plant we are developing in Arezzo in China. For sure, the plant in Arezzo is pretty much bigger respect to the one of China, so the bigger part is relating of this 3 million to the new plant in Arezzo. Thank you.
Thank you.
Thank you, Mr. Mazzoleni. Next question comes from Ms. Arianna Terrazzi. Please, the floor to you. Ms. Terrazzi, kindly unmute your line.
Yes, can you hear me?
Yes, we can indeed. Thank you.
Presentation, hi Max. First, I would ask a clarification on expansionary CapEx. The plant in Arezzo will be ready next April, but when you, but could you recall us when this production site and the new lines in China will be at full regime? And to avoid misunderstandings, is it possible to know what revenues level can we assume when at regime? And lastly, a follow-up on profitability and costs. So far this year, you were able to manage well components purchase, but I was wondering if you could provide more color on this front and an update on cost dynamics. Thank you.
All right. So about the production capacity, we basically we will close our production facility in Tregozzano, which is another place nearby Arezzo as well, and we will start in mass production, basically 100% of activities in May into this new plant, which is again nearby Arezzo. And we will add, starting from January, also an assembly factory in China. Thanks to these two adoption, we have enough production capacity to product internally around 350 million in revenue. So we thought it was good for our company to make these investments now to prepare ourselves for the next 3-5 years, where we see a potential very strong growth, and to make these investments right on time. It's important to be ready to capture the growth later as it will come. In terms of gross profit margin, mainly our capability to strengthen the relationship with the key silicon vendor, which are partners of SECO, like Qualcomm, Intel, NXP, and many others, is providing us also the capability to buy components, CPU, processor, at a lower price, or let me say, at one of the best price available to the market. It is giving us a competitive advantage in terms of pricing, and of course, at the room where we are improving our gross margin on the existing customers. I don't know if it is enough, Arianna, or do you want
Thanks,
more?
very clear. Thank you.
Okay.
Perfect. Thank you, Mr. Razzi. Next question comes from Mr. Bharath Nagarai. Please, the floor to you.
Hi, good afternoon. Thanks for taking my questions. I have a few, please. One is just a follow-up on the net new capacity. Sorry, I think you said you're shutting down, if I'm not wrong, one of the old factories, and the new one that you're building will take its place, and you'll start production from May. So in terms of the net new capacity increase, what would that be? Is that 50% still, or is that lesser than that? That's the first question. And second one is around, could you speak about any looming supply chain risks? For example, this Nexperia export ban, which seems to have now been lifted, and also higher memory prices in the industry. How diversified is SECO in terms of the supply chain? And the last one, just further clarification on the CapEx. Should we kind of assume we have 20 million approximately of CapEx currently for 2025, 2026 each year? Should we just increase 5 million for each year for the new capacity that you're trying to build? Just wanted to make sure that I get that right. Thank you.
All right. So about the first question, I confirm is 50% net, meaning that from where we are right now, 50% plus, it will drive our production capacity in total at 350 million potentially in revenue. That's for what regard the production capacity. In terms of risk on the supply chain and what's happening with Xperia, yes, you are completely right. It was a problem basically during the last couple of months. We did a lot of work with our internal R&D to select pin-to-pin compatible alternatives, which we are now validated. Hopefully, we had enough, stock in our warehouse to fulfill the demand of the product by the end of the year. And so for the next year, we are replacing basically the majority of this such of components with new components, pin-to-pin compatible, validating them thanks to our internal R&D very quickly, and make them available into the bill of material to enable our purchasing to acquire the goods. I think regarding the CapEx, as always, Lorenzo is 3 times better than me to cover the point. So Lorenzo, the stage is yours.
Yes, thank you. For what concern the future, and you were talking about our average 20 million CapEx. Also, if we take a look to last year, this is correct that 15 million is in general represented, that we can continue to have this number for what concern intangible. We have on average 5 million on tangible. This could increase a little for what concern the next year, including these development CapEx, but I would say in a range between 3 and 4 million, not more for next year. And I would say 2-3 million in addition for this year. So
okay.
Yeah, development CapEx, but that will not change in a significant term our CapEx trend, our CapEx figures.
Understood. Thank you very much. Just a quick follow-up, if I may. In terms of the October book-to-bill ratio, have you seen any further improvement from, let's say, the slight dip that we are seeing in the graph in September? Thank you.
No, you are meaning the order intake or the book-to-bill?
The book-to-bill, sorry.
Well, the book-to-bill is always like a cardio.
Yeah.
And the reason why is so simple. For example, it was higher in August and July because we had also holidays, so we did less production, and this is the reason why it's higher. When we was back and we made a lot of revenue in September, it went down, but it's not in absolute term. I would suggest to you guys to see the left part of this slide where you can see the order intake month by month, and this is where you can see actually the trend of the business.
No, absolutely. No, thank you for that. That's very useful. The reason I asked the question is because you have said in the statement above the book-to-bill is consistently above 1 for the first half. Hence my question. Thank you.
Yes, as I said, it is looking the book-to-bill is still above 1.
Okay. Thank you very much, Max.
Thank you.
Thank you.
Thank you. Next questions comes from Miss Alexandra Sova. Please, the floor to you.
Hi, can you hear me?
Yes, we can indeed.
Okay, great. Thank you for your presentation, and then a couple of questions or follow-up on my end. If I remember correctly, during your last presentation, you said that you had roughly 24 million in design wins and new contracts that will generate, let's say, new revenues next year. So maybe an update if you are on track with these projects, and if you see any risk on delivering these 24 millions, and if you are gaining, let's say, achieving new contracts, new design wins. This is the first one. And the second one is maybe some clarifications on Clea. Though as I can see, you increase slightly the proportion on recurring revenues of the total, but doing some algebra, some maths, it seems that in absolute value, the recurring revenue stays at about 2.1, 2.2 million in the quarter, so the same as the last couple of quarters. So how is the conversion rate of let's say project to recurring revenues going on, and what is the evolution of the recurring revenue you expect in absolute terms in the coming months and quarters? Thank you.
Right. So let's start with the evolution of the recurring revenue in Clea. We are expecting to see and to continue to see progression quarter by quarter. Oh, excuse me. On the recurring revenue side, I think it will be next year much better, because we have few customers, but very important, that will run into the mass production on the software side, and therefore will contribute in the recurring revenue later next year. In terms of design win, it's all confirmed. We got this 24 million that are related mainly to the 2026. I think it's important to mention, based on our business model now, we are working on new customer and new opportunity. But if we get something now, you will have an effect maybe in the last quarter of the 26 or later in the 27. So we are at the full speed now to collect important new business, but that will generate additional growth and additional revenue later in 2027. But what you mentioned for the 26 is fully confirmed, is on track in terms of R&D so far. So far, so good. Thank you very much for your questions.
Thank you.
Thank you, Mr. Sova. Next question comes from Mr. Pietro Nargi. Please, the floor to you.
Hello, good afternoon. Thanks for taking my questions. Two main questions. The first one is on the operating expenses. So we have seen a strong improvement on OPEX in the third quarter. And in particular, if my calculations were correct, there is a decrease on labor costs, both on a quarter-on-quarter basis, but also compared to the third quarter of the last year. So I was wondering if this decrease in a labor cost is also due to higher R&D capex over the quarter? This is my first question. The second one is on the current market consensus on full year 26. So assuming the confirmation of the guidance for 2025, so and looking at the current consensus that is more or less 230 million for 2026, that means organic growth in the mid-teens. I was wondering if you have any comments on that expectation. Also, considering your order backlog is growing by 10%, so what is your feelings about current consensus expectation? Thank you.
So, as you know, Pietro, we are not used to comment the consensus. So we will provide, as always, as we go, we will guide the market across our numbers, as we are now in a phase to prepare the business plan 26 29 for our board. So I don't want and I cannot comment the consensus. About what you said on the labor cost, what you are thinking is completely wrong. So the level of capitalization on R&D is fully stable, even both comparing it with the previous quarter and the previous year. The benefits that you are saying into the labor cost are mainly driven by a couple of effects. We did last year, and I mentioned it many times, a strong work in reduction our fixed cost, and this is a portion of that work. And the efficiencies basically that we had into the production made us capable to deliver, let me say, good revenue stream with less manodopera cost, with less cost of employees related to production. So the saving in terms of cost is coming from production. It's not coming from anything else.
Okay, many thanks for your clarification.
Thank you, Mr. Nasj. Currently, we do not have any questions queued. We will wait a few seconds to give everyone the opportunity to raise their hands. As there are no further questions, I now have pleasure handing over back to the management team for any final comments. Thank you.
Okay, thank you very much to all to follow this presentation. In the next forthcoming weeks, we will be around, especially Clarence, in different kind of roadshow. And anyway, our IR team is always happy to be in touch for any further analysis. Thank you very much to all. See you soon. Bye. Bye.